Hello learners, I am Dr. Shweta Bhatnagar from Department of Commerce. Today in this video, we are going to learn about accounting concepts and conventions. So the learning objective behind the accounting concepts and convention is that you will come to know that behind the sound accounting practices which are practiced worldwide, there lies certain constant fundamentals and principles which are followed by every organization. Although accounting is flexible, it is according to the need of the user that the span of accounting is determined. But whatever may be the extent, the guiding rules and principles are constant so that you can ensure uniformity in the accounting practices, and whatever accounting statements that you see at the end of the financial year, they depict or they interpret the accounting information in the similar way. Before starting the accounting concepts and conventions, let us understand the accounting process and where lies the importance of these fundamental principles called accounting concepts. When we look at the accounting process, it starts from analyzing the sources of information and it concludes at preparation of financial statement. So during this entire process, right from tracking the monetary transactions to sorting them out to recording them in the books of accounts and then converting it into meaningful financial information to be conveyed to the stakeholders. At each and every step, there is a utility of these accounting concepts and principles so that this entire process becomes flawless and the information produced at the end of the financial year or after a stipulated time period is trustworthy. So here we are starting with the accounting concept. When we talk about the accounting concept is the fundamental principle or rule or the basic idea, and sometimes we call it the basic assumptions that underlies the recording of business transactions for preparing the books of accounts. So concepts are basic ideas, fundamentals or assumptions. These are the key points about understanding what accounting concept means. The very first concept of accounting is business entity concept. Now, business as a separate entity. So when we are talking about business entity or separate entity concept, we are talking about the legalities. When we record the financial transactions from the point of the law, business is treated separate from the owner. Business is treated separate from its owner for recording all the financial transactions. Now, what is the implication of this rule? This rule gives you an understanding that from whose perspective the transaction is to be looked upon. The business is the point from where the business transaction is to be looked upon and it should be recorded in the books of accounts. So, when we talk about the implication and of this rule, we say that the owner of the business who invests the money to start the business, he is looked upon not as the owner but as the creditor of the business and it is recorded as the liability. The owner becomes the creditor, internal creditor of the business, and creditor is the liability of the business. We do not write down the liability, the capital contribution in the name of the owner, but we write it separately as the capital. So whenever the business is started, the entry is recorded as capital contributed, and this is the owner's contribution to the business. Similarly, when the owner withdraws the money, you do not write it in the name of the owner, but you recognize it as drawings. Since the owner is the internal creditor, his contributions and his withdrawals are treated as the liability. So when the investment is made, it is treated as liability named capital. When the money is withdrawn by the proprietor or the owner of the business, it is treated as drawings. The implication of this concept is that it makes the accounts authentic and objective. It does not, it prevents mixing of the private transactions of the owner with the business transactions, and it provides a very clear-cut picture that what all transactions pertains to the owner and what all transactions pertains to the business. The second concept is money measurement concept. For accounting purpose, essentially those business transactions and deals which can be expressed in terms of money are to be recorded in the books of account. So, the catch line about this concept is that only those transactions are recorded which are measurable in terms of money. So, this is to be picked up, that the transactions which are measurable in terms of money are only recorded in the books of accounts. So, the rule, if I read it out for you, it is only those transactions which can be expressed in terms of money are recorded in the books of accounts. Let us take an example to understand the money measurement concept. For instance, a business has a land of 10 acres. It has an office building which has got 50 rooms. Then it owns 50 computers, 50 office chairs and tables, and 100 kgs of raw material. All these are quantities which are not in terms of money. So, you cannot record the 100 acres of land or 50 chair tables or 50 computers, but you essentially require to convert them into monetary value so as to record them into the books of accounts. So, if the building or the premises of the business is for 12 crores and the building is worth 10 crores, 10 lakhs is for the value of computers and 2 lakhs for office chairs and tables and furniture, and 30 lakh is the raw material cost. This will be recorded in the books of accounts in terms of rupee value and not in terms of the quantity. Now, moving ahead with the next important concept, going concern concept. Now, when we talk about going concern, we are talking about the life of the business. Every business is undertaken with an intention to continue it for an indefinite period of time in future. That means the businessmen do not intend to close it in the near future. So, the fundamental behind this concept is that it is assumed that the business will continue for an indefinite lifetime and it's not going to close in the near future. For example, if a company purchases a plant and machinery for 1 lakh and its lifespan is 10 years, according to this concept, the time span is extending up to 10 years and the expenses of acquiring the machinery should not be charged in one single year. So, we very systematically write off the bulk expenditure that is incurred for the business and which is going to give the benefit to the business for a longer duration of time. So, we show it not as an expenditure, but we show it as an asset which will work for the business for conducting the business activity and generating the revenue. But side by side, we charge its cost in terms of depreciation, where we systematically write off a certain amount from that machinery and we charge it as depreciation or reduction in the value of machinery, and we show it in the debit side or the expense side of P&L, right. So, we segregate, as an implication to this rule, we segregate the long-term benefits of the business and short-term benefits of the business. Expenditure of business is undertaken to get the benefit out of it. Some expenditures have got a short life and they are to be incurred again and again, but there are some benefits that are expenditures which are incurred for a longer duration. Their benefits are extended over a longer duration of time. So, we classify such expenditures in business as capital and revenue. So, the outcome of this concept is the concept of capital and revenue expenses and incomes. The next accounting concept, which is a byproduct of the previous concept that we have just talked about, that is going concern concept, is accounting period concept. Now, what is accounting period concept? That since the business has a long life, so life of the business is divided into accounting periods called financial year. Due to indefinite life of the business, it is important to summarize the business results from time to time. It could be, monthly, it could be half yearly, it could be quarterly, it could be annual, depending upon the requirement of the business to, have a look at the financial position or the picture of the business. So, Summarization of business results are done at the end of the accounting period, and usually this accounting period is 1 year. In India, the financial year is from April 1st to 31st March of the next year, right. So, 1st April to 31st March is the accounting period in India. The next concept, very important concept, is dual aspect concept, and that guides you in recording the transaction in the primary books of account, and which is called journal and subsidiary books. So, dual aspect concept says that every transaction has two equal and opposite effects. So, if something is getting added to the business, the other thing might be going out of the business or getting deleted from the business. So, when we talk about this rule, the dual aspect or the double entry concept that we call, so it says that every transaction affects minimum two accounts, such that the debit effect is equal to the credit effect. The two effects that we are talking about is debit effect and credit effect. So, every transaction is whichever happens in the business, it has an impact that the debit total is equal to the credit total. For example, if a machinery is purchased by check, so what is happening? Machinery is coming into the business and the payment is made from the bank. So, machinery is increasing as the asset of the business, whereas another asset, that is the bank account of the business, is going down. So, these are two equal and opposite impacts. Machinery is purchased for a certain value and the same amount is getting deducted from the bank. A very important implication of this rule is that we get the balance sheet equation or the accounting equation, which says that asset is equal to liabilities. Total assets is equal to total liabilities, or we can say that assets is equal to liabilities plus owner's equity, that is the capital contribution by the owner. So, this is a very important outcome of this assumption, or you can say the accounting concept. The next concept is cost concept, which is very important concept for recording of assets. Assets in the business are not recorded at the price at which they are purchased, but at the cost at which they are acquired. I am underlining and making a circle to a very important word called acquiring. Cost of acquisition is the cost of asset at which the assets are recorded in the books of accounts. So, for example, let us understand it with an example. Machinery is purchased by a business for 5 lakh rupees and an amount of 1000 was spent on its transportation. In addition, 2000 rupees was spent on its installation, and finally, what price should be recorded in the books of account? Is it 5 lakhs, or is it 5 lakhs plus 1000, or is it 5 lakhs plus 1000 plus 2000? The understanding in this concept is that cost of acquiring means from the point of purchase till the asset becomes functional for the business, it is that value which is taken into the books of account as the cost of assets. So, in this we are going to record 5 lakhs plus 1000 plus 2000. So, the total cost of machinery or total historical cost of the machinery which will be recorded in the books of accounts will be 5 lakh 3000 and not just 5 lakhs. Next important concept is realization concept. We also call it revenue recognition concept. When we talk about revenue, we are talking about sales. So, this concept relates to recording of sales. It is very important for us to know that when the revenue should be recognized. It is to be recognized when the cash is received from the buyer or an obligation to pay is created on the buyer. So, that is either the cash is received for the sales or the debtor has undertaken the responsibility to make the cash payment in a stipulated time to the business. So, it is either the cash sale or the credit sale that should be recorded in the books of accounts. And one more thing about recording of transaction related to sales is that actual sales and not the anticipated one. That means we are not supposed to enter the sales targets in the books of account, but it is the actual sales that has happened either in the form of cash or in the form of credit. Let's say for example, a jeweler has received an order of supplying jewelry worth rupees 5 lakhs, out of which an ornaments worth rupees 2 lakhs are supplied by the year end, whereas remaining 2 lakhs and other will be supplied, remaining 3 lakhs will be supplied in the next year. So, we are not going to record the sales as 5 lakhs, but we are going to record it as the actual amount of sales that has taken place, the exchange that has taken place, and that is for 2 lakh worth of jewelry. So, finally, we conclude this video by summarizing what we have talked about. We have talked about the accounting concept, in which we have talked about the business entity concept, then the money measurement concept, the going concern concept, accounting period concept, duality concept, cost concept, and revenue recognition or realization concept. We will continue with the remaining concepts and conventions in the next video. Thank you.